Rob Luna is the CEO and Chief Investment Strategist at SureWest, joining us from Los Angeles with his take on things. Rob, good to have you in the show. Thank you very much for your time. This is not the best discussion to have, just getting into the holiday season. But what do you do? It's a tricky one, right? Given that on the other side of the season, it's going to be hard.
I'm pretty confused now too. Everything that you're articulating, though, I think is really what's creating this type of volatility in the market, if you will, is because there's so many questions, so few answers. Then on a day like today, I'm talking to the consumers. I see what's going on here. I haven't found one single person that's really optimistic about 2023. So the consumer confidence data to me was a little bit of a head scratcher as well. But to your point, this would be the most widely telegraphed recession in history. Companies are preparing for it. The consumers prepare for it. And let's remember, the S&P is going to probably finish this year down somewhere around 20%. You got some big tech stocks, Amazon, Google, down 50%. So it's not like a lot of this has not been priced into some of these names. So to your point, expectations are very low. If we can just get the Fed, and I thought that was going to happen a week ago, to soften its language a little bit, I do think we could actually see a rally in markets.
But that's hard, right, in this environment where the Fed still, even though they say they have a handle on things, are not sure if rate hikes and all the ones that have already been announced have had enough of an effect on controlling inflation. They're still not sure whether inflation is under control.
Well, they're definitely not sure. And I think they're a bit confused because some of the data points that they're looking at today and all of a sudden concerned about are actually a little bit better than some of the things they saw 10, 12 months ago and weren't worried about. So I think that's really the conundrum that the market's in, is if you're looking at what the Fed is saying now, they've all of a sudden become much more hawkish. And we all know that these interest rates are going to take a while. There's going to be a lag in the economy. But if you look at some of the things like housing starts, home sale prices, look at the price of a barrel of crude oil, it definitely looks like inflation is coming down. Employment's still pretty low. So I think that's what's giving the Fed, some cover here. But I'd have to think if we see things soften a little bit, if we see that number tick back up, that we're going to actually have to see them change their language somewhere around the first quarter.
Okay.
Somewhere around the first quarter, Rob. I mean, right now, if the consumer is confident and the earnings are looking pretty okay, and perhaps that recession that we're talking about maybe comes later than expected, are you suggesting that it could be shallow then?
Yeah, I mean, I actually was one of the few people in the camp that there could actually be a soft landing, and I still think there can, but I don't really believe that the Fed is, looking at the data right now, seeing things soften and just saying, hey, at least let me soften my language. Let's take a little bit of a pause here. They've actually came out the day after, one of the Fed governors saying that we could get a little bit more aggressive, and that's really what spooked the market. And we saw this sell-off until today when you had FedEx come out, Nike come out, consumer confidence. It seems to me, and I've been doing this for a long time, the market is looking for any reason to rally here. And it's just, the million-dollar question is, when is the Fed going to change their language? What exact data point are they looking for to change? That's what everyone's trying to kind of jockey position for right now.
So where are some of the opportunities then in this environment? Where do you think it's necessary to be going at this stage?
Yeah, well, the opportunity is clearly in the things that have gotten beaten up the most, and that's not what you would call the safe assets, because if you look at some of the dividend-paying stocks, they've held up remarkably well, down 4%, 5%, 6%, where technology has been decimated. You look at companies like Amazon, Google, Meta, these have been cut in half. I don't think any of those companies are going to be out of business 3 to 5 years now. Meta trading at a discount to the S&P 500. But I think the biggest opportunity in the U.S. market by far right now is in the S&P 600. The small companies trading at only 13 times forward earnings, big discount, bigger growth there. If we can get the Fed to lighten their language, I think that index could rally 15 to 20% next year.
Yeah, I was wondering, you're betting big on small caps in this environment where the uncertainty is still looming, but I get your point on how it's correlated to the Fed's language. You like Amazon and Farfetch as well, Rob?
Yeah, I like Amazon a lot. Anytime I've had an opportunity in my career to buy Amazon after it's been cut in half, it's worked out pretty good 24 to 36 months later. And Farfetch, this is definitely not for the weak of heart. This is a company that's an online company, and they have basically become the behemoth in luxury online sales, which is a $300 billion industry. Very little of that being done online. Farfetch has done a great job. But that's been a stock, I think, especially this month, that's really been a victim of tax loss selling. People have piled on that. The stock's down below $4 now. I personally think if we can get some stabilization, that stock can see 10 to 12, which is over a double, sometime during 2023. It's probably my top pick in this milk.
Right.
Great. Rob, thanks so much for your insights, and thanks so much for all your help this year. It's been very insightful, and you have a very Merry Christmas and a Happy New Year. Goodbye to Rob Luna of Shore Vest. We'll see you in 2023.